Well, good afternoon, everybody. Good evening, depending on where you are in the world. Hope you're all doing okay. This is Sam Evans with you of Online Trading Academy, one of the lead instructors for the company as well. I'm currently based doing this webinar live from Houston, Texas. Unfortunately, we have got terrible storms here, thunder, lightning, and we've got very bad internet and connection problems. So I do hope that there's not too much of a delay on what I'm doing here and that you can hear and see everything. Please keep me updated as I go through this as well. If you can't hear me or if you've got questions and so on, I will be checking the chat window as well regularly just so I can see questions, but I am working off of one screen. Good. Thanks, Jason. That's good. Just keep me posted on there so I know as well. All right, lovely. Well, listen, it's a real it's an honour for me to be part of this leverage special. When I was asked to do it, I jumped at the opportunity to spend some time with you guys, as I do like to do these regular webinars. And leverage, what an interesting one. I was thinking, well, how can I spice this up a little bit? The Good, the Bad, and the Ugly, one of my favourite films. I thought, heck, you know, there's so much leverage that's a good thing, and I'm coming last in the day, and I'm sure that you've already had many people talk to you about leverage and obviously what it involves. And I'm assuming at this particular stage, active participants in webinars here I wish I could give you some free leverage, absolutely. I'll try and leverage your education, though, obviously, with what we're going to talk about today. But I wanted to basically get into the point of saying, hey, look, I don't want to just talk about what leverage is. I think we all know about what that is, correct? I think we all understand at this particular stage how leverage works. I know that the four speakers before me went through that. But I do want to tie leverage into what I'm going to be talking about here as well, how using leverage the right way with probability and risk is the way to really move this forward and give you a little bit of an understanding in a more detail of how Online Trading Academy and myself and my colleagues approach the subject of leverage as well. So with that in mind, I mean, what we're looking at, and I know why we're all here, and this is, you know, I'm taking a slice of, I'm going to just do some slides with you first, and I'm going to go over to the charts and we can take a look at some different things on here. The application of the Online Trading Academy core strategy as well. The reality that I tend to find, having taught over 6,000 people around the world, is that a lot of people come to the markets because they have specific financial goals, and I understand that. But the reality is most people don't really ever achieve that. And why is it that they don't achieve that? What is typically the problem behind it? Typically the reason that they don't achieve their goals is because they're not thinking and acting in the right way. Yes, I'm a retail trader. I have been on the other side of things. But most people, but I'm lucky that because I've been on the other side of the market, I've seen what goes on there as well. And the reality is, guys, that there are really only two groups of basically trading people in the world. There's the institutions and banks and the retail traders and investors. The institutions and banks, as we know, are very, very profitable here. The retail traders and investors typically struggle. It's a small percentage of people who actually manage to make this work. Well, the reason why is obviously there's a lack of education, but also it's the thinking and it's the way that they handle their leverage, the way that they handle risk and the impact that they actually therefore have on their probability of success. There's many factors in here. My job in the limited time that we've got together is to try and get you thinking like these people on the left-hand side of the screen, the institutions and banks. The reason why here at the Academy we have a very rich history of educators who have been mentored by people who grew up on the financial floors. I myself have been fortunate enough to be mentored by a man called Sam Seiden, who I know many of you are very, very probably aware of. He's a regular contributor to here on FX Street as well, and he helped me train my brain to just look at the market through a different set of eyes. Okay, that's what we're going to do, because when you start to look at that, we can use this wonderful thing of leverage to help us. And guys, think about the biggest corporations as well. They use other people's money, and that's all leverage is using other people's money in a way to benefit you as well. But if we're going to do that the right way, we have to learn and think and act in a successful manner to emulate these institutions and these banks as well. This all comes down to timing the market and identifying market turns and moves before they happen with a very high degree of accuracy. This is what institutions do, guys. Institutions and banks, major hedge funds, are buying at extremes and selling at extremes, and they're taking on more leverage and more risk when most retail traders and investors are actually offloading their risk. It's a difference between the reality and the perception of what's going on. And when we go to the charts, this will make an awful lot more sense to you as well. What I want you to think about here is, how does an institution handle leverage? and how does a retail trader handle leverage? Because they're two very, very different things. Do you understand, guys? So we've got to kind of differentiate between the two. And when we differentiate between the two, what's going to happen on here is we're going to have the ability to kind of think and act a little bit more like these major institutions, and also act like them and hopefully get a little bit more of the results that they do as well. One of the things I wanted to show you here, I just wanted to really share this because I don't know how many of you guys have seen this, but I know that I think it was the speaker before me today. I was looking at the roster of all these great educators on here today. And one of the speakers, I think the one person talking before me, was talking about having the plan and trading the plan. This, what I'm showing you in front of you right now, is a really little good thing for you to kind of take some notes down on. This is the foundation of what any good trading setup or business should have. And what I want to really show you is it all starts with this first segment of the risk management. Now, when you're entering into a business like trading, currency trading, the risk is something that needs to be controlled from the start. So the number one priority that you need to have right now is controlling the risk. You see, you could be the world's most horrible trader. I mean, you could be getting it completely wrong all the time. But if you're only limiting how much of your account that you can lose, then you're going to give yourself a long enough time to stay in the game to get that consistency. And that's going to come from that order execution, the skills that you'll build on that, and getting a greater market and technical knowledge on here. Well, guys, those three elements here, risk management, order execution, and market technical knowledge, that's what I teach as an instructor. That's what I can give people. Okay, I can give them tools and lessons and practical applications of how to make that work. What I can't give people is this. You see this here, discipline? Discipline is something that comes from the individual. If I could bottle up discipline and sell it, I'd be the richest man in the world, I think. But unfortunately, I can't. That's something that comes from the individual. And obviously, as your discipline gets stronger, your psychology gets rock solid, your confidence grows, and that all-important experience comes as well. But this first segment, risk management, is a key thing. It's huge because obviously that is where the dangers of the leverage can actually really take us off the rails in that particular manner as well. So what we're going to do is we're going to focus on how this leverage really, really impacts us. So there's three key elements, okay? Probability, risk, and the all-important leverage that we're going to be talking about right now as well. These three things, okay? Now let's just talk about why this is so important. It doesn't matter what technique you're going to bring to the market to trade, investing, day trading, swing trading, whatever it would be. This could be any business in the world, guys. It could be any business in the world. It doesn't really matter, okay? The most important thing to understand is if you're going to be successful, okay, you need probability on your side. I.e., you need to know what you're doing, right? There's no guarantees in those. There's no guarantees that you open up any business that business is going to be successful. But the more you know about that business, the more you know about how to handle your market, the more you know how to read your market and work in the environment of that market, the more likelihood that you're going to have success with it. And obviously the risk is a huge part of it, what you take on, and then the leverage that you use. Well, every good company uses leverage, right? Every company does. It's the way that you can grow quicker. It's the way that you can expand and reach your goals. But here's the problem, guys. If you take a look at this leverage here, most people are attracted to the Forex markets because of leverage. I know there's 24-hour-a-day volume, you know, there's all those good things, the information there. But leverage is the big thing that attracts a lot of people. I hear students all around the world, why did you come into Forex? Oh, you know, I can start with very little and grow my account. Well, that's true, but you can also start with very little and end up with less. You can also start with a lot and end up with a lot less, you know. They always say, what's the quickest way to make $1 million in the market? Start with $10 million and use leverage. You know what I mean? That's how you end up with it, because you can easily break that down. Well, most people out there, most novice speculators and traders in the market come to the market because of leverage. Yes, while leverage is fantastic, what does increased leverage give you? Increased leverage gives you increased risk. We all talk about compounding. Compounding is great. As Einstein said, the law of compounding is probably the single most important law in the universe. However, compounding doesn't just work on the positive, it also works on the negative as well, doesn't it? So by just chasing into this because of leverage, we are then dealing with a double-edged sword that can help us but also hinder us, and it can increase our level of risk. Okay? Just going to answer some of the questions while I'm looking at. It's a very interesting animal, as Nathan's just saying on here. the thing that you've got with it is, yeah, everybody focuses on the positive side of it. You know, if I can just keep making more, making a percent of a percent of a percent, well, that's so true. You can do the mathematics on it, and it's right. But the problem is if you're using leverage and you're not adjusting position size when you're wrong and you're making downside or drawdowns on the account, you can actually take an account and unwind that count in the very, very quickly. Great question as well. Does it work in the long run? You know, it's so down to you as a psychology as well. I'm actually here teaching a class right now, and I've come out on a break just to do this webinar, but I'm with a colleague of mine called Chuck Fulkerson. And Chuck and I were just talking about this with the class that we've got here in Texas. And see, the thing is, as a day trader, I like to trade futures markets as a day trader and use Forex in my longer term things as well. I like to just use an amount of money with all I need in the account to generate an income and then slice the profits off the top. Yeah? Do you understand? So that's because there's only so big that you can get in certain markets. The beauty of the Forex market is it's a market that you can just really trade heavy size in. And when I managed money with a fund based in Norway, that's what we did. We worked in the Forex markets as well. It is, isn't it? Absolutely. It's a phenomenal thing when it works. It is incredibly damaging when it doesn't work. And my point that I want to make on this as well is while we love leverage, it's great. Don't start by focusing on the leverage. What we need to do is start by focusing on the probability. So if I look at it like this, if you've got a solid core strategy, a solid trading plan, if you know how to stack the odds in your favor more on here, then you can control your risk. And then when you've got risk under control, this is the opportunity to take on leverage. You understand that? The solution that we've got here, and this is the solutions that we like to work with and teach in Online Trading Academy, is to have that combination of a good solid core strategy to put probability on your side and to handle risk for when you have your drawdowns, but then also embrace the leverage afterwards. So what we're saying is, yes, we'll use the leverage once we've got the probability on our side. Because here's the thing, guys, if you can't, you know, successfully risk 1% of your account and make money, how are you ever going to risk 2% and 3% and so on? Because, you know, it's very inviting when you've got that buying power. So, you know, as my colleague was just saying, you know, he only likes to keep a certain amount of money in his day trading account so he doesn't ever overload, because he gets tempted, because guess what? He's a human being. So what we need to do, guys, is we need to come at the market, and that's what I'm going to suggest to you guys. Yes, embrace leverage. You need leverage. You need it to actually get anywhere that you want to get to achieve your financial goals. But when probability is on your side and your risk is under control, then it's about time to use the leverage. Don't come in loading up the boat saying, hey, you know, if I load up on this trade, it only takes 1 or 2 trades, I'm going to make money. Because unfortunately, guys, that is a recipe for disaster as well. And Nathan's saying, my feeling on compound is when I'm in a trend, I would take profits at certain levels on trades already winning, compound the profits. But this is all or nothing way of thinking. There's another thing. This is what I was saying about the good and the bad and the ugly of it as well. It's very good. It's very, very good as well to think about a strategy, particularly where maybe you could add to a position when you're right and you embrace that leverage, but make sure that you're not ever going to sacrifice the profits. And we can talk a little bit about that when we go to the charts in a little sec, okay? Because I know what you mean. You know, you can be on the right side of things, and there's 2 techniques. We can either, you know, take some profits on the particular trade on here, or we can actually build the position. But you've got to accept the different outcomes. The key thing, though, is we want to embrace the maximum amount of risk when we start the trade. So when we have the probability stacked in our favor, and that's when our risk is lowest. And that's what why we're going to go to this next little section here and talk about that. Because again, this is where timing is. Taking on the leverage is about when you time the market for your entries. Let's explain that in a little bit more detail, because I'm not just slides here. I want to go over to the charts as too. So I said to you right at the start of the presentation, okay, what we're looking at here is emulating the most successful traders, emulating the most successful investors, doing this the right way as well. So how is the money really made and lost in the markets? Well, it's the buying and selling between those institutions and banks and the retail traders and investors who we talked about before as well. So what we're doing here is learning to think a little bit more like an institution. Institutions have to trade differently to us. Does that make sense? Why do you think an institution has to trade differently to us? Well, the major thing is because they trade much bigger size. And the bigger position sizes that you trade, you have to kind of basically give yourself a different workable strategy to be able to get into a position as well and build that position over time. Yeah, they've got all those robots out there. You know, I know people who, you know, programmers and so on who work for these companies, and they've got algorithms and all that. But that's like scalping, guys. Big position building is a very different thing. And, you know, it all comes down to really understanding how to read the chart and see what the footprints of these guys are. When are they taking on leverage? When are they taking on the greatest amount of risk that they're going to control? That's when they're going to really use the leverage in their favor. And then when the trade starts to work, they can build on it and work at it from there. Well, we get that from the charts. Okay, we get that from the charts. Now, one of the things to remember, and we're going to spend a bit of time on the charts, and then we're going to incorporate how leverage works into this, guys. It doesn't matter what yeah, I'm never gonna know why people buy and sell. Let me make that very, very clear. I'm never ever gonna know exactly why somebody is buying. I'm never gonna know exactly why somebody's selling. I don't have a universal mind-reading machine that allows me to tap into the brains of every single market participant out there and tell me when they're buying, when they're selling, and so on. I get that. And I know what the reasons may be, i.e., earnings reports, news, balance sheets. There could be announcements from the Fed. I mean, look, we've got the Scottish referendum today. The results are going to come out in the morning UK time. That's put a lot of things on here. I mean, I've been tweeting about that, the pound dollar. I've been quite bullish on the pound dollar over the last couple of weeks, you know, in the face of that downward trend as well, tweeting about it. And again, why? Because my opinion is that the market came to a good point to take on leverage because the risk was low and the probability of a rally was high. But again, I'm still going to be building that, factoring that into a trade plan to make sure that I'm not trading recklessly. So I don't know why other institutions have been buying the pound lately. Maybe they think the same thing as me. All I care about, though, is obviously whatever the thoughts and perceptions are, that's going to create actions to buy and sell. And I want to know what the actions that the big institutions are taking, what that looks like on a price chart. Because when I'm never going to know the whys. I'm never going to know. I know potentially why people are going to buy and sell, but I want to know where they're buying and selling. Does that make sense, guys? Because that's where I want to buy, that's where I want to sell. Because at the end of the day, the strategic principle that I'm trying to that we teach and that I'm sharing with you is you're always going to have the lowest risk and the highest reward in any position when you get into the market at or near where it turned in price. Because the turn in price was created by institutions taking on the greatest amount of leverage at that particular time, building a position, using leverage in a favor because they were controlling it with a low risk, and also because it maintained the opportunity of having the greatest potential reward if the trade worked out. It's almost like I'll buy more when it's cheap, I'll sell more when it's expensive. That's the time to embrace the leverage. Does that make sense, guys? I'll buy more when it's cheap, and I'll sell more when it's expensive. That's the time to use that leverage. And then once you've committed to the trade early on and your risk's taken care of, then we can kind of build in some other strategies around it as well. So what we need to do is to time the market turning points in advance as well. And the way we time that is looking for our supply and demand areas and seeing where basically orders are out of balance, where supply and demand is out of balance, to give us a clue when we should be entering and taking on obviously the greatest amount of leverage with the smallest level of risk and the highest level of profitability if the trade works out as well. So let's just come to this last little bit, and then we're going to go and spend the rest of the time on the charts, and we're going to kind of look at that and apply some different kind of ways of thinking about this. Okay, so if you take a look on this, is really, it doesn't matter what technical indicators you use, it doesn't really matter what kind of different order. Okay, very nice, like the idea of cheap or expensive relative to the recent trend or price action. Excellent. Safe leverage. Let me answer this question from FX Bokeh first of all. What is safe leverage? Well, you've got to think about this. You've got to think about what is safe for you as an individual. What is safe for you as an individual? See, when you've got a set of results, say this. If you've got a higher, and I'm going to answer this question because it's really, really important for everything, and we can carry on afterwards. If you've got a good track record, if you've been trading consistently, if you've got maybe a track record of 50 trades and you've done the same trading strategy over 50 trades, right? And you look at that and you can say, wow, you know, I've been 60% profitable over that course of action. That's a good thing, right? Let's say, for example, you had 60% profitability and your average winner was 2 and your average loss was 1. So you've maintained 2 to 1 risk to reward ratio and you've been right over 50 trades 60% of the time. You've got a good feel, haven't you, at that particular point of what you're capable of. Do you understand? You've got a good idea of what you are capable of, right? So therefore, finding that out would have required you to take trades. Yes? Well, what you don't want to do is be risking too much that if you would have got a majority of your trades wrong, that you would have wiped out your account. So I say, look, 1%, and with Forex position sizing, micro lots, mini lots, it's easy. 1% is more than enough when you start out. 1% risk is more than enough when you start out to risk. More than enough. Because if you've got to go through 30 to 50 trades and you're going for 2 to 1 trades or 3 to 1 trades, you don't know if your strategy is going to be good enough yet. You don't know what the results are going to be. You've got to do that strategy to actually get the results to then analyze the performance, correct? So why take on too much risk? Take on an amount that if you did get it wrong, it's not going to hurt you too much. Now, let me stress this to you as well, though, guys. If you're risking 1% of your account and you have 5 losses, you've technically lost 5% of your account. Well, the 1% risk is now 1% of the 95% of the account that's left. Is everybody clear on that? Can you just give me an acknowledgement that you're clear on that? So you're really risking 1% of what is in your account right now. Now, a little tip I would give you all here is this, and this is something that I do in my own accounts as well. I don't increase my percentage. Say I risk 1% of my account. Okay, so I had a $10,000 account, I'm risking $100. My thing is every $5,000 I would step up to the next level. So I'd go from $100 if it was $10,000. If it gets to $15,000, then I risk a new 1% being $150. So actually I'm staying, as it grows between 10 and 15, I'm sticking at 1% risk, but it's 1% on the original 10,000. So my account might be at $13,000. Well, technically, I'd be allowed to risk $130, wouldn't I? $130 is 1% of $13,000. However, I wouldn't reward myself until I got to 15. So every $5,000 I reward myself by resetting the 1%. What that also means is when I'm making it's great, but I'm not increasing my percentage, which means I can draw down quicker if I'm wrong. Is that clear, guys? Yeah. So I'm not increasing my risk until predetermined points. Exactly, JJ. Yeah. And the reason I do that is I do it as kind of like a psychological reward. So it's like, you know, as that money's been made, okay, now I'll reset what the 1% is. Do you understand? But if I go below the initial amount, then I have to reset the 1% as well. And a good little way to do that, instead of basically keep adjusting, you should go, well, I'll risk 0.8% or 0.9. So it means if, you go down a little bit, you don't have to keep adjusting the numbers. So I will increase the percentage. Well, I'm increasing the percentage. I'm only increasing the percentage after certain targets have been hit, and I do that as a reward instead of keep doing it after every trade, because you're going to keep it, that 1% is going to keep changing all the time. Now, as you grow as a trader and you can see what your statistics are, if you're consistent risking 1%, could you step up and risk 1.5%? You tell me, could you start risking 1.5% of your account? Could you risk 2%? Absolutely. If you've got a track record that proves that you are consistent and you can make money using the strategy that you're using. Does that help, guys? I mean, it's a great question that you asked as well, but that's just the way that I do it. I like the reward mentality. It just works for me doing it that particular way as well. And I'd always say to you, you've got to start real small because you don't actually know what you're capable of. And if you're not making money consistently yet, then you've got to give yourself a chance to make money consistently, haven't you? All right? All right, so getting back over to this, what we were talking about. When is the time to take on the leverage? Well, the time to take on the leverage is basically where the greatest opportunity lies. Well, all markets are tickets, guys. They're tickets to buy, they're tickets to sell. The easiest place to get into the market is here at the current price. Yeah, because that's where price spends most of its time. But if the market drops down to the lows, like $10 here, we're likely to see the biggest amount of orders to buy. Why? Because there's very little downside risk by buying at 10. There's more downside risk buying at 60. Do you understand? And what an institution does is it's got the majority of orders out there to buy low, okay, and the majority of orders out there to sell high, because that's where the lowest risk is. The lower you buy, the lower the risk. The higher you sell, the lower risk. The risk is in the middle when there's more fluctuations possible to you. Yeah? What I'm saying to you is I want to take on and maximize my leverage, okay, with a predefined risk when it's safe to do so. Okay, so I want to, if I'm going to be buying absolute lows, if I'm going to be buying nice daily lows on the market with a nice tight stop, I will maximize my leverage to define the position size. Okay, that's what I'm saying. So if I've got like only a 20 pip stop at a particular level, then I'm happy to risk full 1% within that 20 pips. Do you understand? Heck, the zone of risk may only be 10 pips. I'll risk 1% on that 10 pips, but I'm only going to take those trades where the probability is stacked in my favor. And if you take a look at this, guys, the probabilities are always going to be stacked in your favor where the greatest amount of unfilled orders are. Now, our core strategy here, guys, is all about this. You take a look at what we're seeing on the chart here. This little area where we've got our black lines, and you see the little yellow box on here. I know a couple of things from this. This is an area where I'd want to basically use leverage and take on that position because it gives me the smallest financial risk, but it also gives me the best opportunity to take on my leverage. What do I mean by that? Well, in this yellow box, imagine this bit. I want you to just focus on the yellow box here and the strong move away in price. This is just orders, guys. This is basically more willing buyers than more willing sellers in an area. See how prices move sideways in this particular area and then they shot away from this area very, very quickly. Do you all see that? Well, that tells me two things. The first thing it tells me is in this little yellow box, there was a battle going on between willing buyers and willing sellers. Sellers were selling to buyers, buyers were buying from sellers. But at one point in time, those sellers dried up. All the sellers disappeared and there were still people willing to buy. How do I know that? Well, because price moved away from the level so strongly. If there were not more willing buyers than willing sellers in this area, what would have happened? Well, the price would have just stayed at this particular price level because there would have been equilibrium. Do you understand? There would have just been perfect equilibrium. So I know for a fact that there were more willing buy orders in here. Okay, now why do you think there were more willing buy orders? Because at that particular time, somebody like an institution decided this was a cheap place to buy based on their analysis. So this is where they wanted to take on the trade. This is where they wanted to maximize and get involved in the position. And I also know that it was likely an institution that had more willing buy orders here. Why? Because we as retail traders do not have the buying power to be able to cause a rally like that. Do you see that rally here? We don't have the buying power to do that. Do institutions have the ability to do that? Do institutions have the ability to cause rallies in the market like that? Absolutely. We as retail traders, we don't. Does that make sense? So the next time price comes back to this area, what I want to do is I want to take on my low risk and use leverage in my favor by maximizing a position to buy when prices pull back to this zone here. Okay, and I want to put my order in with those unfilled buy orders with a nice tight stop loss below this particular area here. Because what I want to do is I want to maximize buying in this position here, but I want to be out if it goes below this area because that's the point at which I'm proven wrong. Okay, so if you think about it, why would I want to be buying here? Well, because this is the point where the institution stepped in, and also this is low. I want to take on the leverage when it's low. I want to take on the leverage when prices are high, and I want to avoid the middle as much as I possibly can. That's all this is, guys. It's just unfilled orders, and with our stop and our entry and our target, we can do this. So let's talk about this in more detail and by going over to some charts. Okay, guys? Let's go over to some charts for a little bit. So I'm going to fire up, I'm going to go over to some charts right now. Okay. And I'm going to go over there. Now, could you just let me know if you can see my charts all okay? Okay. Okay. Right. Absolutely. I've been meaning to ask. Your strategy is not based on setups, but on levels. Absolutely, JJ. Absolutely. Yeah. Nathan, is that great? The hard part is you have to basically buck the short-term trend to enter the position. Absolutely, and that's a challenge, okay? Because what you've got to imagine, trend analysis is a huge, huge part of this, Okay, but it's having an idea what causes a trend change. Orders. Okay, orders. That causes a trend change, doesn't it? Big orders, right? So what we need to have to do, and what we have to understand here, guys, is when is it safe to buck the trend. There's a lot of other things to it. This is what our odds enhancers are. This is what we teach, obviously, in the academy as well. But you're completely right. So what we need to understand is, we would never recklessly just buy. Okay, we would never recklessly just buy it if it's in a downtrend or sell it in an uptrend. But a good point is this. Let's go over to the pound dollar. I think this is a great market. I've been tweeting about this for a while, guys. I've been quite bullish on the market when it was in this downward trend, because you can see on here. See this downward trend that we've had in the market. Okay. This downward trend in the market. See this? I know that this rally that we've seen here taken quite a few people by surprise, having seen this rally. Well, why did that happen? Well, all it tells me is, at this particular point in time, let me just turn my snap mode off here. At this particular point in time, I know that institutions decided to step in. Institutions stepped into the market at this particular point. Okay? They stepped in because, I tell you what, retail traders don't have the buying power to be able to cause a rally like that in the market. They really, really don't. Okay? So I know they did. But would that have been predictable beforehand? Well, let's take a look at it. What's going to be something that's going to be able to stop a downtrend like this in a daily chart? Well, we need to find where the institution stepped in. Well, let's take a look and go to a big chart on here as well. And what you're going to see in here, is, if we look back, just want to mark off this area here for you. Really important. Now what you notice is in the middle here, 1.6, big round number, lots of psychology on here, okay? Now we had a downward trend going on here, okay? We had a downward trend on here. There's a couple of things that I noticed about this particular zone. This particular area here, the last time, opposite of a rally, a fall, just a rally, yeah. Opposite of a rally is just a fall, yeah? If institutions are doing all the buying and selling, that doesn't this mean for some institutions but buy a lot and other had to sell a lot? Absolutely, but also if you think about it, a lot of institutions are selling to retail traders, i.e., look at this, yeah? Everybody, every piece of news out there, Nathan, every bit of news out there over the last few weeks has been mega bearish about the pound. Okay? Every institution's been bearish about the pound. If you go over here, let me show you something. Right? So I want to show you this anyway because it'd be good. You can jump in and follow me at some point. It'd be great. I like to do a lot of. I like to tweet about this. This was a tweet I did on September the 10th, 8 days ago. People getting too bearish on the GBP right now, already a little oversold. Wouldn't be surprised to see a decent rally over the next few weeks. This was a tweet that I did on September the 10th. September 11th at 62, a test of 165 is on the table based on my chart outlook. Okay? So why was I saying this? Well, because if we look back to last week when I was doing this, we were coming into an area at 160 where we'd rallied from 160 up to 170. Now below this, there's no significant buying, is there? In fact, the only other area I can see where the institution stepped in below this is here. Okay? Here. Now this area here, I like too. I know a couple of things from this area. Okay? A couple of things is price spent very little time at this area and look at the strong rally away. Price has not been back here. This is around 155 and a lot of analysts have been talking about it. Well, if the pound doesn't hold this whole zone here where we're sat at the moment between 158 and 161, we're probably going to go down to the 155 area. Yeah? And they could be, because we're going to talk about this, and I never know yet that the profits is a really important part as well. They could be taking some profits as well. So we're going to talk about where would it be smart for us to also look at next. So absolutely, because I don't know how long this downward trend is going to keep going for. I think, according to the monthly charts, and we're in a massive area. This is a huge, I mean, institutions seriously stepped in. If this 1.6 level holds, we've got a really good shot of getting back up to 168, 170, but there's going to be interim profit targets as well, because all I'm doing is reading the footprints of these buyers and sellers, the institutional buyers and sellers, not the retail buyers and sellers. Because if you think about it, every retail trader out there was focused on the downward trend on the pound. So they were taking on leverage, they were taking on risk. What are institutions doing here, guys, at this particular point? They were actually decreasing their risk on the way down, selling pounds to people who wanted, basically buying pounds and short selling it. But who do you think, whenever everybody else was selling down here, what do you think institutions were doing here? Institutions were buying. Clearly, they're buying from those sellers. So leverage, they're taking on their maximum amount of leverage when it's low, whereas most people are taking on their maximum amount of leverage when it's already gone down. Yeah, right. So good job, good job. I'm glad you weren't selling into that area, major area. Okay, very yeah. So listen. At least it was the first blue bar. At least you knew when to stop, right? So now here's the thing. What we're saying is by timing it, right? So now what we need to look at is, well, where did institutions take on the leverage? Where did institutional footprints? Well, what I'm really keen on now, and the next area I'm looking at, is the next important area is this. This area here. Okay? Now this area here, let me just give you some numbers on this. Let's give you some numbers, okay? I'm looking at 165.38 to 166.47. According to the chart, there was a downward trend, there was a pause in here, and then clearly institutions are more willing sell orders than buy orders in this particular zone here. How do I know that for a fact? Well, price would have stayed there, wouldn't it, if there were enough buyers to meet the sellers before we had this huge drop to the downside and now this rally. So think about it like this. If prices can't get above 166.50, where are they going to go to? They're going to go back to here, right? They're going to go back to where they fell from last time, the 170.84. Here, at this particular point, this is an important area, okay? This is kind of like our middle point. But what this clearly shows me is if the biggest institutions, and they're the only people who can create those kind of moves they're the people who can create those kind of moves on a weekly chart. We can't. We don't have the ability to do it. But we're thinking, well, look, if I'm going to use leverage and risk, shouldn't I be doing it in the places where the biggest institutions do that as well? So I know for a fact that now in this zone here, this is where I would be happy to short sell the pound dollar again, between 165.38 and 166.47, because my risk is small, so I can maximize on my leverage to contain that risk. But if I'm right on that particular trade, I'm going to get the maximum gain as well, aren't I? I'm going to get the maximum gain on that as well. Does that make sense? If I'm wrong on the trade, I get out of it. I've got the room to go, so I can wait for a pullback and ride this trend up to the 170.84. But listen, I'd be happy just trading this thing back down to this 161 area again. And there's a decent 400 pips there. The point I'm trying to make is I'm tying in an understanding of risk and leverage, how they go hand in hand. Okay? What leverage is all well and good, but if you don't have the probability taken care of first, if you don't have the probability and you don't understand how to put probability in your favor first, what is the point of taking on the leverage? Do you understand? Yeah? We want to embrace risk when the market is low, at areas where institutions are happy to embrace risk, at an area of demand where we've seen clearly rallies. We want to sell at areas of supply where we've seen these drops, because who creates these drops? Institutions. Who created this rally? Institutions. What you typically find is the retail client takes on more risk after a move's happened. The institution is taking on the risk before the move happens, right? Two very, very different things. So we need to think and act like those institutions. Understand that? Now, what we can also do is the earlier we enter the move. Let's go down to a smaller time frame a minute and just show you this. And this is another quick thing I would like to just go through with you on here. If you take a look at those, I'm just going to drop this back down to a daily chart for now, because this is kind of like in looking where we're probably going to go to next. See now, this, if we go to a smaller time frame and embrace it, you can see there's been more points where the market's rallied. So there was another great area of demand right here after the initial move happened. After this initial move happened on here, look what happened here. We formed another area of demand. We pulled back to that area, and then the market rallied once again, didn't it? Do you see that? So this particular point here is where the institutions have added to their position. Because here's the cool thing. If we'd been buying down at this area here, if we've been buying at this down here, knowing that we were coming to a major area on a weekly chart, because remember, this area here was located really low down on this weekly chart. So if we use that bigger chart to guide us, let me just go back to my 120 chart. Absolutely. I mean, it's yeah, during that time, bullish was over, if I remember correctly, so it started catching a lot of traders off guard, yeah. It's hard because bulls and bears can both come up with valid trade setups, depending on the analysis. Absolutely. Well, I just trade what I see in front of me. Do you know what? I don't read any of the news or anything. I just trade what I see in front of me. So until this 62.50 area holds, I got no reason to want to be fighting it. Likewise, on this chart right now, with everything that goes on, the big area in question that we're going to have on shorter term trading is going to be here. You see, I'm not going to be buying into this area between 64.50 and 65. Why? Because in this particular area here, look how prices fell from this area. Clearly institutions were selling more than they were able to sell, and there were not enough willing buyers to handle that order inventory. So that's an area where I want to be selling too. And I'll be looking to the opposite area, and this would be a great profit target for me down here at 162.70. The other point is, though, if we bought low and we're riding this trend, an area like this gives us a really good add-on point. Yeah, an add-on point. And what an add-on point is where I could say, well, I've already in the trade from here. If I'd have bought down here at 160.79, have I got any risk up at 62.58? No, I've just got profit, haven't I? I've just got profit, which is great. So this would be a good point to add a little bit more and buy and take on and use the leverage in my favor to increase my position size. But if I'm going to increase my position size here and take on more leverage at this particular point, what I've got to make sure I do is don't let this thing go all the way back down again, because I'm going to be losing on the way down that way. Do you understand? And I can give back my profits. So what I thought I'd do, because of the time and everything, is go through these concepts with you. And in my next webinar, I was going to talk about trade management in more detail and how we could actually maybe start to use a position that we're already in to take on more leverage and develop it at that particular point. What I want you to think about here, guys, is I want you to think about a big picture. I want you to think about true lows, true highs. Sometimes you're going to miss a trend, that's fine. But what you need to do is step away from the chart and really think about, what is the chart telling me? Well, objectively, guys, when I look at my chart on here of the pound dollar, all I'm seeing here is the biggest market players bought here and the biggest market players were selling here. So to create those moves, they had to take on leverage. They had to maximize their leverage to buy as much as they could or sell as much as they could. That's where they use their leverage and where they controlled their risk, their downside. That's where I want to be entering, in the same areas as that. And that's what the core strategy that we use and we teach here, that I have introduced you to here on FX Street, as is what involves it. Guys, if you want a little bit more information about everything I am going to do a webinar on picking levels in the future, absolutely. What I wanted to do, because of obviously the time and everything, and I know and I've already overrun a little bit on this, but for the 45 minutes that I've got on here, let me just leave you with a couple of resources I just want to show you. The first thing is, if you want to follow what I'm doing, I never have enough time on here, but I'm gradually doing more and more as it goes through on here as well. So if you want to follow a little bit more of what I'm talking about, I give some mini lessons on my Twitter feed. My Twitter handle is here. I've just placed that. It's at Sam Evans Trader. You can be able to see it on there. You'll see me putting a lot of my tweets and pics on that as well. Also, another place you can go to is you go to our website. If you go to our website, onlinetradingacademy.com, I'll show it for you. And I believe as well, if you go to tradingacademy.com on here, if you go to resources in the left, you click on the resources, and you go to the Lessons from the Pros newsletter, you'll see on here the Forex article. Rick Wright and myself, Rick Wright and myself, we write these Forex articles every week as well, so you can start to follow us on there, and those articles are also recirculated on FX Street. But my next webinar, guys, it'd be great if you could join me, and we'll expand a little bit more on picking levels and using those as re-entry points to add into position and take on more leverage. So I hope that helps, guys. Thanks. I hope the connection was good as well. Thank you very much for participating on here as well. It's really great to have you and you guys all taking part in it as well, and thank you so much, FX Street, as well, for having me. Guys, be well, and I'll see you in a couple of weeks as well. Bless you all. Have a great trading week. And by the way, be careful with that referendum tomorrow. It could get really, really volatile. So just take it easy. Don't overtrade and jump into things, because you know what? You could get chopped to pieces on that. So just look after your accounts tomorrow with that. Okay. Thank you very much, everybody. Take care. Thank you.